Hi, I'm Chris Bruner, CEO of Spectra Capital. This is Brad McGill, our Managing Director, and we're going to run you through the strategy.
Thanks, Chris. I appreciate that. Just by way of background, I have over 30 years of experience in the alternative investment and risk management worlds. I've known Chris for several years. When he first approached me about the opportunity of forming Spectra and managing this type of strategy that we're here to discuss on behalf of investors, it was clear to me it was one of the most interesting and attractive opportunities I'd ever seen.
Absolutely, and I've run 5 companies prior to this, the most recent of which was exited to a subsidiary of TransUnion. After that, I began investing my own capital in this strategy, and I've got over $1 million of my own capital in the fund today.
Right, and that's very important. It shows how aligned our interests are with our investors and how focused we are on taking care of our investors' capital. Spectra Capital is offering Spectra Velocity Fund, a special situations commercial real estate debt vehicle offering a targeted 20% net return annually to its investors, including a 10% preferred return. We offer quarterly distributions, we do not lock up our investors' capital, and we intend to be able to provide these returns with low volatility. We are able to offer attractive terms like this because of our underlying strategy. In the special situations commercial real estate debt market, we are focused upon providing fresh capital to property owners who may be in some level of strain or even distress with their existing debt positions. They typically have a pending repayment obligation and are running out of time quickly to be able to satisfy that. We are able to step in with fresh cash, take out the existing lender, reset the capital stack, and allow the borrower more time to be able to satisfy their obligations and pay us back over the term of the loan. We do intend and expect for our investors to repay us. However, in situations where they cannot or will not repay us, we are also willing to step in and foreclose and sell the property. We're comfortable that we can provide these kinds of returns because of the low loan to values on our loans. We typically expect a loan to value of 50% or less, meaning the property is worth generally at least twice of the capital we deploy into the loan with a first lien position. This means we are heavily over-collateralized and in a strong control position in the event that the loan does not perform the way it's expected to. We are able to generate these kinds of returns because of some fundamental market inefficiencies, which we are able to take advantage of. And there are several of these inefficiencies. The borrowers, even in a normal scenario, often have time closing new loans to pay off their existing debt in a timely fashion. We are able to step in and give them more time. On the other hand, the lenders often have structural constraints. Banks in particular have limits on the types of commercial real estate loans that they're allowed to finance or refinance. And that's in a typical market. In this market, the situation is very difficult as many traditional lenders, including banks, have stepped back completely in some cases from commercial real estate lending. And on the investor's behalf, everybody would like to receive high levels of current income with low volatility, which is exactly what we are positioned to provide to our investors. Spectra occupies a unique position in the market for a number of reasons. First, due to its relationships and its infrastructure, we have strong access to deal flow. We receive a large number of applications to access our funding and are able to cherry pick the best deals that meet our risk-adjusted return criteria. We are positioned to execute quickly and with creativity. We have the team to be able to understand how to put these deals together prudently and in a short period of time. And that's due to the management team that we have in place. We currently have commercial real estate experts with over 80 years combined of experience in the sector and an excellent infrastructure built around them. Risk mitigation ultimately is the key to executing this type of strategy successfully. We have several different risk mitigation components that we implement. First is the low loan to value that I mentioned. By having a loan to value of 50% or less, there is a large buffer in the event that we do end up needing to foreclose on a property and own it in a short period of time. Even bad loans are expected to turn out well in the Spectra Fund. We're broadly diversified. We expect to have ultimately up to 100 different loan transactions at any one time spread across a wide range of different geographies and types of property. And we have rigorous standards in terms of our underwriting. We perform thorough due diligence. We use title insurance and other risk mitigation tools very actively to protect our investors' capital. which allows us to offer a unique return profile, particularly given other types of existing real estate vehicles. A typical mortgage fund has historically provided a return of 10 to maybe 14%, but with a high loan to value and typically leverage used to enhance returns. We don't use leverage. We don't borrow any capital, not currently and not anytime in the near future, to enhance returns for our investors. The real estate syndication, on the other hand, has seen a number of deals over the last few years in which different investors will pool their capital to buy one or a small number of apartment complexes or other assets. This is equity. It's exposed directly to the ups and downs of the real estate market. Returns have been good for the last few years. However, with interest rates going up and property values coming down, it's very unlikely that returns will continue at the pace that they have in the past. On the other hand, the Spectra Velocity Fund offers exposure to debt. We have a first position. We control what happens to assets in the event that the loans are not repaid. It lowers volatility in the fund. It enables us to provide what we believe will be a consistent 20% target return on an ongoing basis. When we look at the kinds of loans we typically want to deploy to, it involves a number of different basic criteria. First, we look at the property types. We will lend to a wide range of different kinds of commercial real estate assets, including light industrial, retail, multifamily, storage, even raw land in certain cases where they're fundamental value drivers. We are not, however, currently planning to deploy to office. Like many investors, we're concerned about the future of office assets. However, virtually every other type of commercial real estate asset we would be willing to consider as long as it meets our criteria otherwise. Our transaction size typically is $2 million to $10 million, really clustering on the smaller size of that. That allows us to have a broadly diversified portfolio, and that's also a part of the market where there's relatively little competition. It's difficult for a property owner who may be entering a strained or distressed situation just to raise money from friends and family to bail him out at that level. It's too much money. But on the other hand, that's too small to get a lot of competition from hedge funds and more traditional special situations real estate lenders. There's less competition, we're able to price our funds aggressively, and we're able to cherry pick transactions. Our typical length of loan is anywhere from 3 to 36 months, tending to cluster in the 6 to 12 month range. What we would think of as extended bridge financing. We like that part of the market. It's relatively short term, meaning that we're not exposed to long-term interest rate change trends or to changes in underlying property values. We can be flexible and reposition the portfolio on an ongoing basis. We have an innovative fee and liquidity structure as well. They're typically more akin in terms to a hedge fund, in terms of the fee and liquidity, not the strategy necessarily, than to a traditional real estate fund. For example, we charge no management fee. We do not ask our investors to pay us to do our jobs. We offer a 10% preferred return, which means that the first 10% of returns that come in every calendar year go in their entirety to our investors. Once that 10% preferred return has been satisfied, we then split the returns for the remainder of that calendar year 50-50 between the investor and Spectra Capital. This is what leads us to be confident in targeting the 20% return rate that we've discussed. In terms of liquidity, we do not have a lockup provision. This is very unusual in commercial real estate investing. Most funds typically have a 3 to 5 year lockup in order for them to invest and then sell assets. Because we invest in short-term debt instruments, we are continuously receiving interest payments and receiving repayments, meaning we don't have any need to lock up our investors' capital. On a quarterly basis with appropriate notice, we will endeavor to redeem our investors in full once they let us know that they may want out. It also allows investors to add more funds on a quarterly basis. We intend to pay quarterly distributions also based upon the recurring ongoing cash flows. And these distributions either can be paid out on a quarterly basis and received as income by the investor, or can be reinvested on an automated basis. And here's a case study, Chris, of how Spectra plans to deploy its capital. The last transaction that you did prior to forming Spectra was in Puerto Rico, a $4 million light industrial property. And I think you want to give some information about the details of it?
Sure. So this is in Aguadilla on the west coast of Puerto Rico. I lent $1.16 million and ended up generating a 52% return in over a period of 6 months.
Right, and you had a confession of judgment, personal
That's right.
guarantees,
We had all kinds of
additional
protections
collateral.
in this. We had a confession of judgment. We had warrants in the entity that owned the property. We had a personal guarantee for one of the high net worth investors.
Right, and with a property worth $4 million, it's a loan to value of just over 25%. You're heavily secured, heavily collateralized, with a very attractive return.
Exactly.
This is important, I think, for two reasons. One, not only does it show the types of transaction we're going to be allocating to and the return opportunity, although they won't all be this good necessarily, but in addition, it speaks to the motivation of the borrowers. In this case, the existing property owner was in trouble. His business plan had not worked. It was taking longer and costing more than he'd expected, and his existing lender was demanding to be repaid in full. He was at risk of foreclosure. So you stepped in, you took out the first lender, took in the primary position loan with all the protections we talked about, bought the property owner extra time, and the transaction worked out well for everybody, including a very attractive return in the kind of deal we're going to be deploying to.
Absolutely. And I'm particularly honored to be working with a team with such extensive experience.
I totally agree with you. When I look at the people we have involved, they're all top tier. Craig Lawrence has over a decade experience at the highest levels of commercial real estate law. Pat Vertucci has been involved in commercial real estate lending in the New York City area for over 2 decades. Jack Krupe was involved in a $1 billion fund back during 2008, 2009, during a difficult environment. Daniel Sanabria, CFA, has been involved in alternative investment management, administration, and finance. I have over 25 years experience. It's a great team, and it's an interesting combination of professional and personal long-time relationships, along with bringing in top-tier talent to complement the real estate expertise.
Absolutely, it's an excellent team. Thank you so much for taking the time to review this with us.
We appreciate the chance to talk with you about Spectra and its growth plans, and hope that we have given you a sense of why we believe this is such an attractive and unique opportunity at this time in the market in particular. Thank you.